All right, let's dive right into this explainer and unpack something wild happening in the market right now. The massive $40 billion valuation of Revolution Medicines. If you're doing stock due diligence in the biotech sector, this is honestly a fascinating case study. We're looking at a clinical stage biopharmaceutical company attempting to conquer some of the absolute hardest to treat cancers in the world. And yet, without a single commercial product on the market, Wall Street has valued them at over $40 billion. Today, we're going to break down exactly what is driving that staggering number. So here's the roadmap for today. We're going to hit the crass cancer revolution, break down Revolution's clinical moat, dig into their financial health and cash burn, and wrap up with a market sentiment and risks. Part 1, the KRAS Cancer Revolution. We're going from undruggable to a booming market. To really get what Revolution Medicines is doing, we have to start with the KRAS mutation, which is present in about 30% of all human tumors, including a crazy 90% of pancreatic cancers. Think about this. For literally 3 decades before 2013, KRAS was the ultimate dead end. Scientists called it undruggable because the protein just didn't have deep enough pockets for drugs to grab onto. They tried all these indirect approaches, and they pretty much all failed. But then the code was finally cracked. We saw the very first approvals hit the market in 2021, and fast forward to early 2026, the landscape has just exploded. We now have 6 approved KRAS drugs on the market and a massive pipeline of 741 active drug entries. It's like a scientific gold rush. Now, check out the contrast here. It's like 2 completely different worlds. On one side, you've got the G12C mutation. This is where all 6 of those approved drugs live, mostly targeting non-small cell lung cancer. It's commercially proven, sure, but it is becoming incredibly crowded. Meanwhile, over in the G12D and G12V mutation space, it is a massive, totally untapped white space opportunity. These specific mutations actually account for over 50% of pancreatic ductal adenocarcinoma, or PDX patients. And Revolution Medicines has aggressively planted its flag right in the middle of this exact white space. Moving on to part 2, Revolution's clinical moat, where we look at how they're targeting the active state of the cancer. Let's see what actually separates their science from the rest of the pack. Here's what makes them so unique. While older methods tried to catch the protein sleeping, when it was inactive, Revolution built its whole foundation on RAS(ON) inhibitors. These small molecule therapies are designed to inhibit the active, GTP-bound state of the mutant RAS proteins. Basically, they aren't messing around the edges. They are going straight for the engine that drives the uncontrolled tumor cell growth. And honestly, the clinical data they're getting from this approach is jaw-dropping. In their phase 3 trial for previously treated metastatic pancreatic cancer, patients on the standard of care chemotherapy survived a median of 6.7 months. But the patients on Revolution's lead drug, daraxonrasib, 13.2 months. They literally doubled the overall survival time compared to standard chemo. And with a hazard ratio of 0.40, the statistical significance is massive. These are exactly the kind of numbers that earn a drug an FDA breakthrough therapy designation. But here's the thing. They are definitely not a one-trick pony. They're building a remarkably deep bench of therapies. Daraxonrasib is also in phase 3 trials right now for non-small cell lung cancer. Then they have zoldonrasib, which is a G12D selective inhibitor showing a highly differentiated safety profile. What's super strategic is that they are scheduling doublet combinations, like testing zoldonrasib and daraxonrasib together for late 2026. When you look at competitive landscape reports, Revolution actually holds the broadest mutation coverage in the entire industry. All right, part 3, financial health and fundamentals. It's time to weigh the costs of all this innovation. Let's pivot from the science to the ledger and see how a clinical stage company operates without a dime of commercial revenue yet. Because, let's be real, the cost of this kind of innovation is steep. Just in the first quarter of 2026 alone, they posted a massive net loss of $453.8 million. This actually missed analyst consensus estimates by a pretty wide margin. They reported a loss of $2.29 per share when the street was expecting $1.83. But hey, running global, randomized phase 3 trials is incredibly capital-intensive. It takes serious cash to play in this league. But wait, before you panic about that cash burn, you have to look at their war chest. At the end of Q1 2026, they were sitting on $1.9 billion in cash, equivalents, and marketable securities. And they bolstered that significantly in April 2026 by pulling off a massive $2.2 billion capital raise through stock and convertible senior notes. So where is all that money going? Straight into the science. Almost $344 million in Q1 went purely to research and development to push these complex trials across the finish line. They've even updated their full year 2026 operating expense guidance to a hefty $1.7 to $1.8 billion. But structurally, the balance sheet is actually rock solid for the near term. Their debt-to-equity ratio is super low at 0.19, and they have an exceptionally strong current ratio of 6.80, meaning they have more than enough liquidity to cover their immediate liabilities. Which brings us to part 4, market sentiment and risks. Let's explore this massive tug-of-war happening on Wall Street right now over this stock. If you look at the analyst price targets, you'll see a real divergence, which is super interesting. The consensus target is hovering around $144.67, but major analysts who are closely watching that phase 3 pancreatic cancer data have recently upgraded their targets aggressively. Oppenheimer bumped theirs up to $195, and Mizuho pushed theirs all the way to $215. They are clearly signaling a belief that this pipeline is a blockbuster in the making. And there is a seriously fascinating tension in the ownership data right now. On one hand, the institutional bulls are dominating. Over 94% of Revolution's stock is owned by hedge funds and institutions, with massive recent buys from players like Nextech Invest and Millennium Management. But on the flip side, we see some potential insider bears. Company insiders actually sold off over 132,000 shares last quarter, cashing out roughly $21.5 million. Now, insiders sell for all sorts of reasons, but in a pre-revenue company with this kind of valuation, it is absolutely a data point that due diligence demands we notice. This whole dynamic, the amazing science versus the massive cash burn, has pushed the stock to new 52-week highs, giving them a market cap of just over $40 billion. Because they have zero commercial revenue yet, their PE ratio is sitting at a negative 26.66. Wall Street is paying an absolute premium based entirely on the future potential of those ROS1 inhibitors. So as we wrap up this explainer, the ultimate due diligence question for you is this. At a $40 billion valuation, has the market already perfectly priced in their incredible clinical victories in pancreatic cancer, or does a pipeline with the broadest KRAS mutation coverage in the industry justify an even higher ceiling? The science is revolutionary, the cash burn is immense, and the stakes for patients literally couldn't be higher. Thanks for joining me on this explainer, and we'll see you next time.